for the next year or two. I know a lot of us are in our annual budgeting time of year, maybe even strategic planning, looking out 3 to 5 years. So we're basically looking to our crystal ball here and see where this economy and interest rates and inflation will be headed for the next few years. Basically, I'd like to start out by saying I can summarize my whole presentation with a quote from a very famous author. And the author is Charles Dickens. I'm sure you've all heard of Charles Dickens. He wrote that book, A Tale of Two Cities. And if you remember in that book, the most famous line where he said, this is the worst of times, this is the best of times. Well, basically that describes not only the US economy, the best of times, the worst of times, but it also describes credit unions. And so we're going to use that throughout my presentation and basically just talk about this economy in that perspective. First of all, let's jump to my first slide and answer the question, are we in a recession or are we going into a recession? Well, to answer that, no, we are not in a recession. And two, we don't expect to be in a recession. If you notice this chart here, this is US economic growth rate. I have a gold line on my chart. Now, economists should always have gold lines on their chart. That's where the economy wants to be, where it wants to grow at. And that's right at 2%. You know, every year we can just naturally or organically produce 2% more stuff. Well, how are we going to do this year? If you notice, the bar for 2022 only has 1% growth. So we have slow growth, below trend. So if you want to use the word recession, call it a growth recession, but not a full-blown recession like you see with my red bars there. In 2020, we had a red bar recession. Back in 2008, 2009, we had a recession. We do not expect that we'll have a recession this year or next year. And then by the years 2024, 2025, we expect the economy to be growing at its normal pace of around 2.2%. So no recession. What are the takeaways then for your credit union? Well, if you notice, I put up a blue box on the chart. And point number 2 is we believe this scenario of a growth recession is going to happen with about a 50% chance of happening. Now, a full-blown recession could actually happen. Point number 3 on my list is a full-blown recession, about a 30% chance. Why could we see that? Well, as we know, Europe is having some difficulties right now with the war in Ukraine and energy prices. Basically, energy prices have gone up tenfold so far this year. And so we could see Germany and France in a recession. Of course, if they go into a recession, that pulls all of Europe in a recession, and that will hurt our exports from the United States to Europe, which could slow us down. Also, if the Federal Reserve raised rates too far, too fast, and if China continues their zero COVID policy, put all those together, we actually could have a scenario where we have a recession. We only give that a 30% probability. And then the remaining 20% probability is my point number 1 on my takeaway list, where basically a 20% chance we could actually see a soft landing where the economy actually grows at the 2%, but we don't really expect that to happen. So no recession forecasted, but a slow growing economy. Now, some of you in the audience may be saying, wait a minute, I've heard on the news that we've had 2 consecutive quarters of negative growth, which is true. In the first quarter of this year and the second quarter of 2022, we did see the economy producing less goods and services. But what actually caused that? Well, first we want to say having a slow growing economy like this or negative growth, that's only a necessary condition for a recession. It's not a sufficient condition. You need a few other things to happen. Like 1, you need job losses. I'm sure you all heard today that the Bureau of Labor Statistics came out and said we actually added 263,000 jobs in September. So we're still adding jobs at a fast and furious pace. So you cannot have a recession when you keep adding jobs. Also, you need retail sales to be negative. You need personal income to be negative. So there's many other things that have to happen before we're in a recession. Now, what actually caused this drop, though, in output? Well, it was mainly due to inventories. Notice I've added a blue box to this chart. It was the fact that firms were still building up their inventories, but at a slower pace than what they did, say, in the fourth quarter. If you notice in the fourth quarter of 2021, we saw a big jump in inventories of about 5.32%. So Point is, in the first half of this year, yes, we were still building up inventories. Think of, a Target or Walmart. They were still adding to inventories, but at a slower pace. So we had an inventory correction in the first half. We don't believe that's going to happen in the second half. We believe economic growth will resume. Now, let's move on to the big question that we are facing right now with our economy, and that has to do with inflation. So let me put the big question into a poem form. And the poem is this: inflation or deflation? Tell me if you can. Will we be Zimbabwe or will we be Japan? Well, Zimbabwe is a country in Africa that about 12 years ago experienced 1,000,000,000% inflation, where Japan is on the other end of the spectrum. They've had 0% inflation for the last 30 years. Well, hopefully the United States will fall somewhere between that. And let's take a look at the data. Here it is. Notice the blue line on this chart. This is the inflation rate looking year over year. Right now, we're about 8.3% increase in prices from a year ago. Where should we be? Well, once again, economists should have gold lines on their chart. We should be at about 2.5% when using the CPI measure of inflation. So we are way above that. That is shocking the Federal Reserve. The Federal Reserve's number one goal in life is to keep inflation at around 2.5%. Well, so far they haven't been doing a good job. So what are they doing? They're raising interest rates to slow down demand, slow down people's spending in order to get inflation under control. Because when you think about it, what is inflation? It's just too many dollars chasing too few goods. Well, we have that taking place today. We had all those stimulus checks money going out here. Here's my list of inflation factors. Number one, we had a lot of pent-up demand for goods and services. A lot of people are spending a lot of those stimulus checks money now. And there's just a lot of money and purchasing power out there. But number two on my list, we've got a lot of supply chain disruptions, reducing inventories. And of course, when you have limited supply, prices go up. Just to give you an example of what I'm talking about here with this reducing inventories, if you went to the average new car dealership today, say you wanted to go buy a new Cadillac today, in a normal time, if say back in 2019, if they would have say 100 cars on the parking lot, today they only have 25 cars on the parking lot. Their inventories are down by about 75%. So that, of course, is limiting sales and pushing up prices. Number three on my list, just rising energy and commodity prices did push up inflation in the past, but even commodity prices are starting to fall again. Price of lumber, steel, copper are starting to drop. So we have some good news there. So what do we actually expect for inflation for the next few years? Well, remember I said this is my Charles Dickens, the famous author. This is the economy of Charles Dickens, the best of times, the worst of times. Well, this is the worst of times chart. This is the highest inflation in 40 years. So you see that bar there, that big bar for 2022. We expect overall inflation this year to be about 8%. That's the worst inflation that we've probably any of us who are listening to this presentation have seen in our working careers. But we do expect it to drop to 3.5% next year. So once again, the price level is not going down, but the rate of growth is slowing. So prices will still go up, but at a slower pace of 3.5. And then by the year 2024, we expect inflation to be about 2.5%, back to its target. So we got about another year and a half here before inflation hits the gold line where it wants to be, the natural inflation rate in this country. Now, what are the takeaways for credit unions as we're doing our annual budget and strategic plan? Well, I've listed a blue box on my chart. What are the takeaways? Number one, we are seeing an increase in household financial stress. Some of your low-income members are having a hard time paying for their groceries, paying for their gasoline, paying for their rent. So they may not have enough money at the end of the month to make a payment on their credit card or automobile loan. So point number two on my list, we're seeing an increase in loan delinquency rates among low-income members. Our middle and higher income members are doing just fine, thank you very much, but we are seeing a little bit of stress in the low income area. Number three on my list, higher interest rates. It goes together. When inflation goes up, interest rates go up because the Fed raises interest rates to bring inflation back down again. Number four on my list, labor cost. Because of this rise in inflation, our employees are asking for a bigger cost of living adjustment, or COLA. So workers are demanding 4, 5, 6, 7% raises this year. Normal, you go back the last 30 years, people were getting a 3% raise. I was just in Texas a couple of weeks ago, and I did a survey of 400 CEOs in the audience, and basically the average raise was going to be 5, 6%. There's about 20% of the audience were going to give a 7 or 8% raise. They're in very tight labor markets. But labor costs are going up, and that's pushing up our overall expenses, bringing down our net income this year. And then number 5 on my list, just overall operating expenses. Just the cost to run a branch, to maintain a branch is rising. So overall operating expenses are going up, which means our net income will be falling this year because of this high inflation. Now let's move on to the best of times quote from Charles Dickens, and that has to do with the labor market. If you're a worker in this country, an employee, part of the labor class, you're doing quite well because there's a lot of job opportunities out there. And you can see on this chart, like I mentioned, the Bureau of Labor Statistics came out this morning and said the unemployment rate is 3.5%. That actually dropped slightly from last month's 3.7%. But the point is, it is below my gold line on this chart. You can see the gold line is 4.5%. That is the natural unemployment rate. That's where it should be. That's when the labor market, you could say, is balanced or in equilibrium. Just to show you how out of balance the labor market is today, right now we have about 10 million job openings in this country. I mean, just think these job openings, you got unfilled credit union teller positions. You've got, a welder at Harley Davidson motorcycle that job needs to be filled. Throughout the economy, we've got 10 million job openings. But what's the labor supply that's available to fill these jobs? Only about 5 million. There's 5 million unemployed people, but 10 million job openings. We've never seen that big of a gap between openings and unemployed people. And that's pushing up this wages and giving us a very tight labor market. But of course, a low unemployment rate is good for credit unions in one sense. Let me add this blue line to my chart. Notice the blue line. What is that? That is the credit union loan delinquency rate. Basically, the loan delinquency rate is at 0.42% today. That is one of the lowest in credit union history. And there is a natural delinquency rate out there for credit unions. Let me add on a purple line to my chart. You see that purple line? That is the 0.75 natural delinquency rate. That's where the delinquency rate is typically going to be when the economy is good and everybody's working type thing. But notice we are way below that. Notice the blue line is below the purple line. That's showing you how tight this labor market is, that everybody's got a job and paying their loans on time. But it also is, we also can call it a denominator effect in this ratio. Remember, this is a delinquency rate. So we got a numerator and a denominator. And as you know, there's a fine line that separates numerators and denominators. Well, basically, the numerator is just the dollar amount of loans that are delinquent. But the denominator is total loans. And as we know right now, total loans are exploding at credit unions, growing very, very quickly. So the denominator of this ratio is increasing fast, helping to bring this ratio down. All right, but overall, delinquencies are doing really good at credit unions. We're not putting much money into our provisions for loan losses, which is also helping our budget this year, having a little bit higher net income. So what is the forecast then for the next few years for the unemployment rate? Well, you can see that first bar for 2022 here. We're forecasting about 3.6 average for the year. Notice my goal line is 4.5, so we're below that. So we have a tight labor market, but we do expect the unemployment rate to rise over the next couple of years to 4% next year, and then by 2024 to hit the gold line. So notice I've mentioned that year 2024 a couple of times now. That's when we believe a lot of the economy's imbalances will be corrected and come back into balance. So what is, remember I said there's 10 million job openings, but only 5 million unemployed people? Well, the Federal Reserve is trying to pull down the job openings by raising interest rates, slowing demand, but hopefully the labor supply will be increasing. We lost about 5 million Americans over the last few years during COVID who left the labor force. They basically left either because they're worried about their health because of COVID, or they couldn't find childcare for their children. Now those people are coming back into the labor force. And so hopefully we'll be more balanced here by 2024. And wage pressures will come down. If you saw this morning, wages are rising at about 5% for the average hourly earnings. So hopefully we can get that 5% back down to 3%. One easy rule of thumb in economics, that if you want inflation at about 2%, you have to have wage growth of around 3%. And as I mentioned this morning, wages were still growing at 5% on average. Now, what are the takeaways for your credit union from this chart, the labor market? Well, number one, we are going to have a labor shortage for the next 2 years as the unemployment rate approaches my gold line there, 4.5. That means number two, bargaining power is shifting towards employees. Employees are asking for higher wages, or they're threatening to quit. They want better working conditions. They want to work remotely or hybrid. Basically, they've got the bargaining power right now, which brings me to point number three on my list. We're seeing an increase in labor turnover, churning, we can call it, or quits. A lot of our employees are quitting, finding another job paying 10 or 15% more, which you typically see when people switch jobs. Number four, it's pushing up those labor wages, as I mentioned, but it's also pushing up training costs. I'm on the board of directors of a large credit union here in Madison, Wisconsin. We're about a $5 billion credit union, and the vice president of human resources at our last board meeting went into a pretty long discussion how our training costs were booming because of all the turnover in our frontline teller staff. So we're getting all these tellers that are brand new. We got to train them in, and those costs, of course, can get very exorbitant. Number five on my list, that could lead to lower labor productivity. Having all these new tellers, say, on our front line, well, they're not going to be very productive compared to, say, a 10-year veteran teller. And so labor productivity is going to be falling. Takes a little bit longer to do some transactions, a little bit longer wait time on the phone if I call in. And of course, what does that do to member satisfaction? Well, for a lot of credit unions, member satisfaction is dropping right now because of the drop in labor productivity. So I just got listed here basically 7 different ways this unemployment market is being impacted. And like I said, number 7 on my list, it's going to take 2 years for all those people who left the labor force, all those people who worried about their health, and all those people who couldn't find childcare to get back into the labor market. So it's going to be tight for the next couple of years when trying to find workers. Now, let me ask you all, what is the most important price in any economy? Well, is it the price of oil? Is it the price of gold? Is it the price of the dollar? Actually, it's the price of money. And since credit unions are basically money traders, we buy and sell money. That's what credit unions do. We take in deposits, pay one low interest rate, and then take that money and loan it out at a higher interest rate. So number one rule of finance, buy low, sell high. And basically, of course, the price of money is what we're buying and selling it at. And of course, that's just interest rates. So let's take a look at interest rates. Let's take a look at our crystal ball, try to forecast where interest rates are headed for the next couple of years. Well, notice this chart here. This is a chart looking at the Fed funds interest rate. Now, this is the interest rate the Federal Reserve controls through their monetary policy action. So you can see how kind of smooth this chart is. That's because it's controlled by human beings, the Federal Open Market Committee specifically. Notice my blue line, my blue arrow. Basically, where's the Fed funds rate at today? 3.1% roughly. And you can see we're above my gold line, which is the 2.5% neutral interest rate. That's where the Federal Reserve is not trying to stimulate the economy with low interest rates like they did during the last 2 years. But basically, once you go above that gold line, it's kind of like if you're driving your car and you want the car to slow down. You want the car to slow down, you hit the brakes. Notice, because we're at 3.1, which is above my gold line, the Federal Reserve is gently pressing on the brakes today. They're trying to slow this economy down. As they raise rates, credit unions and banks raise their rates. We're seeing mortgage rates go up, which is slowing down the housing market. Auto rates are going up. So all of that will slow the economy. What do we expect to be the highest interest rate? Basically about 4.6% is our best guess right now on how high the Federal Reserve is going to have to raise interest rates. So basically think of the nominal interest rate hitting 4.6 by say next year. And hopefully if inflation falls to say 3.5%, well, if you subtract those two numbers, 4.6 minus an inflation rate of 3.5, that means we get a real interest rate over 1%, which is really what the Fed's goal is, to get real interest rates above zero to kind of restrain the growth of the economy. But then notice in these out years of 2025, 2026, we expect the Federal Reserve to bring the Fed funds rate back down to our gold line where it wants to be at 2.5 to be in a neutral position. That's kind of like driving your car with your foot not pressing on the accelerator or on the brake. It's kind of your foot is just sitting on the floorboard, not doing anything. So the Federal Reserve has a little bit more to go, another 1.5 percentage point increase over the next year or so to get this economy more imbalanced, because we're in a little bit of a disequilibrium right now. I put up a little purple box here just to be a little clear. We expect the Fed to raise interest rates above 4% by the end of this year. Notice we only got a few more months left. Short-term rates will hit 4.6% by the end of 2023. That's what you see in my red little box there on the top of the mountain. And then the goal is to go back to that neutral range of 2.5 to 2.75 by the year 2026. So there is our best guess when it comes to what the Federal Reserve is going to do. But what's that old joke in economics that they say there's only two types of economists in the world: those who can't forecast interest rates and those who don't know they can't forecast interest rates. Well, I'm part of the latter group. This is my best guess on what the Fed is going to be doing with those interest rates. Let's move on now to the second most important interest rate in the world, which is the blue line on this chart, which is the 10-year Treasury interest rate. So think of Janet Yellen. She's our Secretary of the Treasury. She has to issue bonds to fund our $1 trillion deficit this year. That's right, it's $1 trillion, down from almost $3 trillion in the last couple of years because of COVID, but it's still $1 trillion. The interest rate on a 10-year bond that she would sell to us is about 3.7% today. Notice it's jumped from 1.5 at the beginning of this year. So we've seen a big increase in long-term interest rates. Well, how does this impact our credit union? Well, most of us at the credit union world, we don't buy 10-year Treasury bonds. They're too long-term dated. Their maturity is too long. The NCUA examiners would beat us up if we bought a 10-year Treasury. But it does impact the 30-year mortgage rate. Notice the 30-year mortgage rate has spiked now to 7%. At the beginning of this year, it was 3%. It has exploded to the highest level in about 15, 20 years. So very, very high today. But also notice the difference between these two. Notice what we call the spread is, historically, that red spread box I have there is about 1.75. Take the 10-year Treasury, add 1.75 for a little credit risk, because when you lend money to a human to buy a house, they may get hit by a bus and not pay us back. So we have to add on a little credit risk there. But notice where the credit risk is today. It's about 3.3%. There's so much volatility in the mortgage market today that basically Fannie Mae has really increased the credit spread to 3.3%, almost double its normal. That's really pushed up interest rates. All right, so notice with interest rates this high, all those people on my chart who got a loan over the last, say, 15 years, got an interest rate lower than the 7% today. So not too many people are going to be refinancing in the near future when you have mortgage rates that are around 7%. All right, let's do a forecast. What do we expect the 10-year Treasury interest rate to be in the next few years? Because that'll help us determine what's going to happen to the 30-year mortgage rate. Well, notice we believe that the 10-year Treasury is going to be right around 3.5% the next few years. That kind of where we're at today. Remember I said today we're at about 3.7. Basically for the next few years, it's going to average about 3.5. That's kind of where the 10-year Treasury market's in equilibrium or in a balanced state there. So we don't expect interest rates to move much higher than where they're at today for the long-term interest rates. Sure, the Federal Reserve will keep raising short-term rates, but we don't expect the long-term rate to go much higher than it currently is. What will this do to credit unions? Well, look at my next chart here. My next chart is looking at credit union first mortgage originations. So in other words, what's the dollar amount of loans granted over the last few years. Well, notice in 2020 and 2021, we had boom years. We were originating over $300 billion in mortgages. That was double the pace, say, back in 2016 through 2018. So these were great years for credit unions making mortgages, collecting that fee income, maybe selling those loans onto the secondary market through Fannie Mae or Freddie Mac and getting some gains on sales of mortgages. Well, why did it explode the last couple of years? Well, notice the yellow line I've just added to my chart. The yellow line is the 30-year mortgage rate, and you can see it got the lowest in 2021 when it hit about 2.93%. So this shows that housing and mortgages are the most interest rate sensitive sector of our economy. That when interest rates fall, housing demand explodes, and we saw our bars go up. But notice my yellow line has gone up now, and we expect it to be 6-7% mortgage rates for the next few years. What does that mean for our mortgage originations for the next few years? Well, you see these new bars I've just added to my chart. We expect mortgage originations to fall 40% this year from last year, and then fall another 5% next year from where they are this year. Then hopefully by 2024, remember, 2024 is that rebalancing year. When the economy is kind of back to its long run equilibrium, we may see growth of 10%. So you can see those little blue boxes I pasted on those bars. So minus 40% drop this year, another 5% drop next year, and then a 10% pickup. Well, how are these higher mortgage interest rates impacting the housing market? Well, take a look at this chart. If you can see by the title, this chart shows single family housing starts and the building permits that you have to get. You got to get authority from your local authority to actually get to build a home. So you need to get that permit. But one, if you notice from this chart, building permits and housing starts are very volatile. They can be very high one year and very low the next year. So let me put on a green line in there to say this is kind of what we should be doing. Our long run average is we should be building about 1.2 million homes in this country just to keep pace with population growth. Well, notice in the past, we went through a period of overinvestment back, say, in 2004 through 2006, when we built way too many homes in this country. We have a surplus of homes. And if you remember watching the news for a while there, we were actually starting to bulldoze homes down that were brand new homes that were just built because we just had way too much and home prices were crashing. Well, whenever you have a period of overinvestment, like we saw back 14, 15 years ago, it's typically followed by a period of underinvestment. And you can see home construction crashed down to 300,000-400,000 homes being built. Well, what's happening today? Well, notice the blue and the yellow, the latest numbers we're currently seeing, have dropped about 15%. Why is that down? Well, because the Federal Reserve started raising rates in March. They've raised rates now 300 basis points, or translation, 3 percentage points. So it's already slowing the housing construction market here. So housing starts are down 15%. What about the existing home market? About 85% of the housing in this country is existing. This is where you buy my house or I buy your house. Notice my gold line on the chart is about 5 million, and we should be selling about 5 million homes. That's kind of the long run average and keeping pace with population growth and all that. So there's our target, 5 million. Notice the last few years, we were above that. It was a strong housing market, but because the Fed has raised rates, notice my little green box there says we're down to about 4.8 million. But hey, that's pretty close to the 5 million line. So we've kind of re-equilibrated this market, brought demand back down a little bit. So, basically we're not seeing the demand for homes around 6.5 million. It's basically pretty close to that 5 million line today at 4.8 million. Now, the only problem, however, with the existing home market, notice this blue line I've just added to the chart. What is that? That's the number of homes for sale in this country. So we can say there's about 1.3 million inventory of houses for sale in the United States. Notice how low that number is compared to the last, say, 10 years. This is one of the lowest we've ever seen. Very few people right now are willing to sell their house. And so we have a limited supply. And whenever you have a limited supply of something, and relatively normal demand, well, what happens is home prices rising. Last year, home prices rose about 19%. They're still rising today. Well, let's jump to a chart to see what's taking place in the housing market. You see this chart here? This is the Ofeo House Price Index, looking at the 4/4% change. Notice nationwide home prices rose 18.7% in the year ending the second quarter of this year compared to the second quarter of 2021. So really fast. Once again, where's my gold line? What should home prices be rising? Well, in the United States, home prices typically rise about 4.1% a year. But it cycles, sometimes above that, sometimes below that. But right now, we're seeing the fastest increase in home prices in really American history. The big question I get, well, are we going to see home prices crash similar to what they did in 2009? Notice in the middle of my chart there, I've got that little blue text box there saying that, for one quarter, we actually saw home prices drop minus 10%. And for about 4 years, we were in the negative area of home prices falling for about 4 years in a row there. Well, what's going to happen going forward? Are we really going to see another housing bust where home prices could turn negative for, say, 4 or 5 years? Well, I'm going to use the 4 most dangerous words an economist can use. This time is different. Basically, back in 2005, we had a surplus of homes on the market. Too many homes were built, nobody wanted them. Today, we have just the opposite. The housing market is plagued by a shortage of homes. Basically, for the last 12 years, we have not been building enough homes to keep pace with population growth. So, no, we don't expect home prices to keep growing 18.7. It will slow down to that 4% by next year, but we don't expect to crash like we saw earlier. So here's my chart forecasting US home prices. Notice the bar for 2022, about 9%. So even this year, even with, rising interest rates and all that, home prices will still rise 9%, which is more than twice my gold line. So we still got a lot of demand out there. We still got a lot of millennials out there. Kind of blame it on the millennials. Millennials are anybody 26 to 40 years old. So we all know people at 26 to 40. There's about 83 million of them out there. That is the largest demographic group in the United States, even bigger than baby boomers. We used to be the biggest, but hey, we're getting old and we're dying off. And so now the millennials are the biggest, but there's a lot of them out there and they're buying homes because when you're between the ages of 26 to 40, what are you typically doing? Well, you're getting married, you're having kids, and you're buying homes. And so demand's still going to be there. By next year, however, in 2023, we'll see about a 4% increase in prices, right at my gold line. But then in the years 24 through 26, notice those small little bars there, only 2% and 1%. So home prices, we hope to be continuing to grow, but less than the 4% line. Now, why is that? Well, we kind of pull forward their price appreciation during those years into the last couple of years. So they can't keep rising above average for a very long time. So what are the takeaways for your credit union? Well, let me jump to point number 2 on my list. There is this market imbalance. As I mentioned earlier, we have been underinvesting in our housing stock since 2010. For the last 12 years, we just haven't been building enough homes in this country. But number 3, we've had a lot better underwriting of mortgage loans this time. So remember after the Great Recession of 2008, 2009, government stepped in and put in new rules and regulations saying, hey, when you write a mortgage today, you really got to check to see if that person can pay the money back. And so a lot better underwriting this time. So we don't expect a housing bust like we saw 12, 13 years ago. But point number 1 on my list, building material costs are still pretty high. We still have a pretty tight labor market. So even building new homes, they're still very expensive because of those 2 factors. Now let's jump to another major market that we lend to, and that's cars. This chart looks at new vehicle sales. So this would directly impact our new auto lending. But take a look, I have my gold line, about 16.5 million. That's kind of what we should be selling in cars in the United States each year, just to keep pace with population growth, to keep pace with those old junker cars that need to be taken off the road and replaced. So 16.5 million, that's where we should be. Notice that big V shape right during the year 2020, that big white V there in 2020. There's your COVID pandemic. If you want one chart to really show, hey, what did COVID do to the auto market? Well, right there, we saw auto sales plummet, but then come right back. Notice how that blue came right back to that gold line, because that's where it kind of wants to be. But where are we today? Well, notice the blue is below the gold line today. We're only selling about 13.3 million cars. That's at an annualized pace for the last month of August. So it's still weak. Why is that? Well, it has to do with that supply chain problems. We all heard about those semiconductor computer chips coming from Taiwan and South Korea, Samsung making all these chips and other producers. Basically, they had problems making the chips because of COVID, and their workers were on quarantine. Or when the ships got over here in the port of Los Angeles, they had too many dock workers were sick or on quarantine, so they couldn't unload the ships. And then to even truck those chips up to say, Detroit, we were short of truck drivers to get them up there. So we have all these supply chain problems, but they are getting worked out. Right now, auto production, I'd say a lot of GM and Ford plants are back to normal. They are getting the chips. The problem is they still have to rebuild the inventory on the new car lots. They have to basically fulfill the past demand of people, say, placing an order for a car a year ago who are still waiting for that car. But then they also got new demand. So the problem is we're only selling about 13.3 million right now. So you think that'd be weighing on new auto lending, but it's actually not. New auto loans at credit unions are booming right now. And let's turn now to the credit union world. Notice this chart, the title says this is credit union loan growth. And you can see I've got data going all the way back to the year 2000. What do we forecast for this year? 15% loan growth. Notice that is the biggest bar on my chart. Remember I said this is the Charles Dickens economic update. This is the best of times. This is one of the fastest loan growth we've ever seen. Now, what explains this rapid loan growth? Well, think of the quantity effect and the price effect. The quantity being, say, the number of car loans we're doing. Well, the quantity, the number of car loans, they may be up, which is great. But think of the price effect. Think of the price of these cars are also up. New car prices are up 10, 20% compared to just a couple of years ago. So when we do make a loan, we have to make it for a larger dollar amount because of the price effect. So yeah, we're making more car loans because more cars are being bought by the credit union world, but also the price of cars are higher. And so you put those together and you see the 15% there. Then notice for next year, we're forecasting a slowdown to 8%. And then remember by 2024, that's kind of that magic year where the economy rebalances itself, kind of re-equilibrates itself. And we go back to my long run goal line there of about 7%. With credit unions, 777 is the sign of the credit union world. Basically, in the long run, credit union loans grow about 7% a year. Our deposits typically grow 7% a year. And our capital, your cushion, your buffer, your rainy day fund, your capital, that typically grows 7%. So the last 40 years, that's kind of the long run average. So we are kind of slowing down to the long run average, which is what the Federal Reserve wants to do. The Federal Reserve is raising interest rates, so our loan growth slows down. Because remember I said, what is inflation? Too many dollars chasing too few goods. Well, when we make a lot of loans, we're really creating more dollars and creating more spending power, creating more car sales, which pushes up, say, car prices. So the Federal Reserve wants us to slow down a little bit by raising interest rates. So if you notice that blue box I've just added to the screen, why is our loans up this year? Well, we do have an economic recovery that took place. A lot of lending growth surged because of that. Two, a lot of leisure spending. This summer, a lot of our members finally took that vacation that they didn't take during COVID pandemic, and they went out and bought those airline tickets and those hotel rooms, say, by the Grand Canyon, or are they buying restaurant meals? So the unsecured lending is booming. But number 3 on my list, there it is, monetary policy in action. Rising interest rates will weigh on our loan growth going forward. Well, that's one side of the balance sheet. That's the loan side. Let's switch over to the other side of the balance sheet, the deposits, and see what's happening there. Notice this chart is called the credit union savings growth. Where's my gold line? Well, I have it about 6.6. Let's round that up to 7%. Like I said, 777 is a sign of credit unions. Basically, we're expecting weaker loan growth this year. Notice only 5% this year, 5% next year, but then slowly trending back up to its long run average in the next couple of years. So a little bit weak. We're seeing a lot of our members, slowing down their savings. A lot of our members have a lot of cushion right now in their checking accounts. Just to throw out a number that's pretty interesting. If you went back to 2019 and you looked at the average amount of deposits that your members have at your credit union, say you grab the average member at your credit union and ask them, how much do you have in your checking? Add it to how much you have in your savings, add that to their money market and CDs. The average member had about $11,000 in deposit at your credit union between checking, savings, CDs, money markets. 11,000. What is that number today? About 14,200. So they have an extra $3,200 sitting in all of their deposit accounts. They got this big cushion. So they say, why do I need to save more? Let's go out and spend some of this. And so only weaker savings growth for the next couple of years. Now, one of my favorite economic truisms is the following. Economics is the study of the confusion between stocks and flows. Now, how does this statement apply to what we're talking about today? Well, when you look at a credit union and you want to analyze its financial condition, what are the two financial statements that you look at? Well, you look at balance sheets and income statements. Of course, a balance sheet is a stock concept. It shows you the dollar amount at a point in time of, say, your loans or assets, where the income statement is the flow concept. How much net income you made per year, per month, per quarter. What were your expenses per year, per month, per quarter? All right, well, we just got done looking at the balance sheet or the stock concept of your credit union. Now let's take a look at the flows. Here's our first chart. This is our credit union's yield on assets. Remember I said this is the Charles Dickens economy, but it also applies to credit unions. This is the worst of times. Our yield on assets in the first half of this year fell to 2.92%. You see that bar there for the year 2022, 2.92%. Think about that's the average rate on our loans and the average yield on our investments. We were only earning $2.92 for every $100 that we sold. Remember, we are money traders. That's what a credit union is. We buy and we sell money. This chart is what we sell the money for. 292. What was it, say, 20 years ago? Scan all the way to the left of my chart. Back in the year 2000, we used to make $7.34 for every $100 of assets that we sold. But basically, it's down to 292 today. The good news is we do expect it to rise. With the Federal Reserve raising interest rates and the 10-year Treasury going up, notice how my bars are steadily rising for the next few years. That's a really good sign. Basically, if you ask the question, well, why did our yield on assets fall to the lowest ever? Well, you see the red line on my chart? What is that red line? That is the 10-year Treasury interest rate. Remember, we talked about this earlier. That's what Janet Yellen has to pay. Well, notice the 10-year hit its lowest ever back in 2020. Remember, that's when COVID hit. There's this flight to safety. Everybody is buying 10-year treasuries. Well, credit unions have a little bit of a lag time. 2 years after the government interest rate hit its lowest, our yield on assets hit its lowest. We always have about an 18-month, 24-month lag time with the Treasury. So it wasn't surprising that it took us a while to roll over our investments and roll over our loans into those lower rates. But we do expect with these rising, as you probably know, right now you can buy a 2-year Treasury at what, 4.3% today? I mean, that's basically what we're earning on some of our auto loans. So instead of making an auto loan, just buy a Treasury. You don't have to worry about credit risk and all that. Basically, interest rates are rising fast, which is going to bring our yield on assets back up, which is some good news for us. Now, the other course chart that was the worst of times is within our net interest margins. Remember, I said we are money traders at credit unions. We buy and sell money. Well, the profit of buying and selling money, if you just look at that pure operation of taking deposits, making loans, The margin is how profitable that is. And it hit the lowest ever in the first half of this year. It fell down to what, 2.57%, the lowest in credit union history. Credit unions have been around for over 100 years. I think that first credit union was called St. Mary's Credit Union up there in New England. Basically, we've never seen it this low, being, once again, the profitability of buying and selling money, taking deposits, making loans. But the good news is we do expect this to head back up to kind of that gold line. I see my gold line. That's kind of the long run average. So that's not some natural rate. It's just an average rate. But basically, it is going to be climbing up the next few years as all of our loans reprice in today's higher mortgage loan rates and car loan rates, and mainly our investment portfolio. I'm sure most of us had short-term investments. They're all rolling over and repricing into today's higher, say, 2-year treasury rates at 4.3%, which is great. And it'll bring this back up again. So some good news there. Now we get to the bottom line. This bottom line looks at our ROA, or return on assets. You can see by my title there. That's just your net income, or your profits, if you will, divided by your average assets. Notice my gold line in there. There's kind of a rule of thumb in banking. Basically, hit an ROA target of about 1%. Translation, earn $1 for every $100 in assets. But notice for about the last 15 years, our green bars at credit unions have not really hit that target. Now, it did last year. If you notice in 2021, we had a year where the green bar was above the gold line, but we had some one-off events. We had really low delinquencies, so really low provisions for loan losses. In fact, some credit unions were releasing some money from their allowance for loan loss account, which really boosted their bottom line. But we also had a lot of mortgage originations, as we saw earlier. We sold a lot of those mortgage originations onto the secondary market and made millions of dollars on gains on sales of mortgages. So we have these one-off events. What do we forecast for the next few years? Once again, if you're doing your 3 to 5 year strategic plan, where we're kind of going back to the new normal. And the new normal is about 75 basis points, or translation, we only earn 75 cents for every $100 in assets. So it's not going to be the 1% ROA that we used to earn back in the 1970s, 1980s, and the 1990s. This is the new normal. All right, well, let's wrap this up with our economic update summary for 2023. What can we expect? Well, basically, once again, slowing economic growth for the next 2 years. That was that growth recession that I talked about. So hopefully we don't have a full-blown recession where we actually have GDP falling year over year, but we just expect it to slow down to 1.5% pace below the 2% normal. Number 2 on my list, the good news for the Federal Reserve and for all Americans, we do expect the inflation rate to fall over the next couple of years, getting back to its gold line of about 2.5%. Like I said, this year we're going to have about 8%. Next year, 3.5% inflation, but it will be trending down. The Federal Reserve is raising rates, supplies coming back, people are coming back into the workforce. So we're getting a supply side fixing that problem. Number 3, the labor market. Unemployment rate below normal for the next 2 years. So tight labor market, wages still rising, still hard to find workers, training costs still going up, labor costs at credit still rising, and that's going to put downward pressure on our net income. Number 4, longer term interest rates, remember, rising over that 3% the next couple of years. We expect it to stay around 3.5, even though even today, the 10-year treasury is about 3.7. We expect it to be about 3.5 for the next few years. That is being a market imbalance already. Number 5, credit union loan growth slowing next year. Remember, I said this year is the best of times for credit unions. With that 15% loan growth, we expect it to only be 8% next year. One, as the inflation rate slows, remember the price effect. Car prices still rising, but only 3%. But basically, loan growth is going to be slowed down. A lot of people are satisfying their pent-up demand today for credit, and they're trying to get ahead of the game, right? They're taking out the loan now before interest rates rise even faster. So they're kind of trying to time their debt accumulation to get ahead of the Federal Reserve. And number 6, rising net interest margins. Once again, that's the profitability, if you will, of being a money trader. And it's going to be more profitable in the future to buy and sell money, to take deposits, make loans, as the Federal Reserve raises interest rates. And then number 7 and final on my list, credit union mortgage originations falling 40 to 45% over the next 2 years as the Federal Reserve engages their higher interest rates to restrain this economy and get inflation down. And as I said, housing is the most interest rate sensitive sectors of the US economy. And it's really impacting it already with these mortgage rates over 7%. All right, that's my economic update summary. If you have any comments or questions, we can take them at this time.
I got any questions? We're open. No, Stephen, I think you covered it very well. I don't see any hands going up or anybody waving anything. We want to thank you very much for doing this for us.
All right. Well, thank you very much, Grant. Everybody have a great conference.
Mm-hmm.